Hey guys, welcome to the seminar, the webinar today. We really appreciate all the folks that have showed up today. We've got a good big group of people here. My name is Jake Robinson. I'm a fiduciary. I work with Roy Matlock Jr. Advisory. Many of you know who he is, and if you don't, you're in for a treat. Roy's one of the best teachers there is around about financial services. I know this because I've been working with him since 1995, and Roy spent five days a week, 3 hours a day on the Money Game show, along with Dave Ramsey in the earlier days. Roy took a sabbatical off the radio, came back on about 6 years ago, and so he consistently has to be on the top of his game on every trend or new aspect of financial services out there in order for us to be able to serve our clients. And over that time period, we developed over $1 billion of assets under management. That's how much money all of our clients together are invested in the marketplace that we manage. We developed over 50,000 clients over that time frame, and we've just done had a fantastic track record of helping people achieve the financial goals so that they eventually one day they could stop work and have an income and a lifestyle they're accustomed to. So I want you to, we got a few little disclosures here. I want to give you some housekeeping things right now. It's not too late for you right now to take the link that you signed up with today and forward it to a friend, a relative, somebody you care about, a colleague, coworker, that you think, wow, if they could sort out their finances this year and get on track, how much better would our relationship be? And so send that out to them. It's not too late for them to pop on, even if they come on a little bit late. And then secondly, I think there's some disclosures. Lucas, can you put those on the screen? We have them.
Here,
Okay.
hey Jake, I can pull that up and get all that up there for
By the
us.
way, it's Roy's birthday. We're celebrating his birthday by a 2-hour work day on a Saturday.
I'm
That's
having
dedication.
fun. That's it, having fun. So there you go. How about that? Let's do this, and we'll be able to get the whole show rolling here.
All
So
right, this information provided in this seminar is for educational, informational purposes only, should not be considered specific investment, tax, or legal advice. And the strategies and concepts discussed are general in nature, may not be suitable for your individual circumstances. You can discover that later if you need to. Before making any investment decisions, we strongly encourage you to consult with a qualified financial advisor, tax professional, or legal expert to evaluate your unique financial goals, risks, tolerances, and personal situation. Investments carry risk, including the potential for loss of the principal, past performance not indicative of future results. But we are financial advisors and other financial professionals here at our organizations that can help you evaluate. The presenters, organizers, and affiliated companies are not responsible for any actions taken or decisions made based on the information we shared with you during the seminar. By participating, you acknowledge the importance of seeking personalized guidance tailored to your specific needs. So there we go. That's the legal disclosures we'd like to make for you. This is the A to Z's of money mastery. And a couple of things I want you to think about. Our seminars being, is this still part of the disclosure, Roy? Yeah, our seminar is about becoming educated about money. Regardless of the size of your portfolio, our advisors are here to help and happy to do a free review. We'll send you a replay link in the next few days to review, so you can sit back and watch this without having to take notes like you were at a college, a course or something like that. And then I think we got one more slide here, Roy.
all good then.
Okay, so here's what I want you to do. Grab a notepad and a pen, and you're not going to take copious notes, but you do want to do this. This slide presentation is numbered. If you come across a slide and Roy's or one of our advisors will be on today to present, and you see a concept that resonates with you, like, whoa, wait a minute, that's something that I need to do. Write down that slide number and then jot down just a bullet point on why you think it could help you. Or it might just be a concept you're like, you know what, wow, that's interesting. I never heard of that before. I want to learn more. I want to go on a deep dive. Write down the slide number and what you want, why you want to deep dive and what you want to learn. Thirdly, as you go through this, you're going to see ideas and concepts that may relate to people you care about. Those people that you like, wow, I need my mom and my dad to see this. My brothers and sisters ought to be on this webinar with me. Well, you have a chance to send them a replay link. but jot down the slide that makes you think of them, and jot down, why do you think the person you may refer to us would be interested in that concept. So you jot down if it happens to be, how to get tax deferral on investments. What's the best way to do that? Oh, I know my brother has been talking about moving his money out of his 401k. We don't want him to just pull it out and pay a penalty in taxes. There's a way to do it that will benefit him. So as you go through here, jot those ideas down and the slide numbers. And then if it could be just something that you want to go back and you didn't understand something, write that slide down. And what you didn't understand, the person who invited you can get with you and help you sort through your notes and see if we can get you on target and on track. Take this seminar as a way for you to launch 2025 and finally put the worries and stress about what am I going to do about my future. And when you have those stressful thoughts, generally it's related to money or the lack of it. And if we can show you how to cut your costs, how to cut your taxes, how to find money in your budget, how to take the money you have now and get it working harder for you, and then give you a step-by-step written game plan that you could follow and know if you just do the steps, you'll get the results. So with that in mind, I'm going to turn it over to Roy Matlock Jr., and he's going to he's going to get us started here.
All right. Thanks, Jake. And this morning, guys, it's my birthday, 64. I have been doing this since I was 24, and I'm having fun. Couldn't think of a better thing to be doing on my birthday than teaching money. And we're going to roll through some stuff. So what I'm going to do is I'm going to kind of tee up what the whole basics of the seminar is. And then on the end, I'm going to come back and I'm going to give you specifics. So if you're young, getting started, maybe you got kids, whatever it is, young kids, I'm going to show you what I would do. Then I'm going to show you if you're middle age, maybe you're 45, 50 years old, I would show you what I would do there. And then if you're at or near retirement, we'll do the same thing, throwing a couple tips here and there on, see if you own a small business, different things like that. So we're going to get rolling with the goal of creating automatic financial independence. And I cannot believe I misspelled the only word on here on my spell check. Hold on here. I can't do that. So automatic financial independence. And let's try it again. Independence. Independence. Okay, there we go. Is that right? I'm losing my mind here. Anyway, so 6 components of what I call automatic financial independence. So what we want to do is we want to be able to wake up knowing that the outcome is going to happen. And I remember back in the early days when I first got started, I was told something called pay yourself first. Had no idea what that meant because what I was used to was paying everyone else first. I had car payments, I had credit card debt, went and bought a house I couldn't afford. And I did this really early on. And I was like, right after I got involved in this, when I was 24 years old, I was like, how did I do such stupid stuff? And I was married at 24 and I was like, I've screwed my life up already and didn't even know what was going on. And so I learned something called pay yourself first. I got out of debt, made some changes, sold some expensive cars when I finally got from being upside down, bought some junkers, eventually paid them off, got rid of the credit card debt and got me a $50 a month mutual fund being pulled out of my checking account every month. And I was paying myself first for the first time, and that was 40 years ago. And so what I learned was education and advice matters. You've heard the saying, what you don't know won't hurt you. Well, when it comes to that, that's probably the worst saying that's ever been. But the one saying that you can count on, what you don't know about money will hurt you. And you can be side by side with someone that's educated and gets good advice, and they can make the same amount of money and be completely different in their outcome. I used to go in, I'm kind of like the guy that back in the old days where you would go in and they would guess your age or something like that at the carnivals and stuff like that. Well, I can guess your finances when I pull up to your house generally. And if I walk in your house, I can generally guess your finances. And I did that back in the days because what happened is the neighbors always generally make the same amount of money as you do. And I'd want to go and meet with one person in one house, and they would be in great shape, doing great. The other one, they would be in terrible shape, but they all make the same amount of money because most of the time our neighbors, if you ever want to know how much money your neighbors make, just figure the reason they live where they live is because they make what you make. And so it's pretty well like that, but we're going in all these different directions. So the first step the first component is you got to get educated. And so I want to compliment you today. We're going to go through all these different things to help that happen. We're then going to do a review. And what does a review do for you? We give advice in those reviews, but when we do a financial review, we basically break things down in the past and the future. So what has the past brought you? So if I meet with you or one of my advisors meets with you, we're going to say, where are you at? What do you have? What do you owe? What have you accumulated? All that kind of stuff. And we're going to see what the sum total of where you're at has created your life of money. And so your life of money may have started when you're 16 years old with your first job, and now you're 40 years old. Let's do an analysis and take a look at your life of money. That's the first step. In the review, what we do when we meet with clients, we do a review of their past, and then we put in place a plan for the future. All right. And we automate that. And when I talk about automating to where you wake up every month, you have your plan in place, and it's automated. It's being pulled out, drafted out. All you have to do is show up and have X amount of dollars in your bank account every month, or it's coming out of your paycheck, and we automate the end result. All right. So that's how we go there. And we're going to offer to each of you, if you're listening right now, a phone call. All right. And the reason we do a phone call, find out it's low risk on your part, and you get to find out if we're a fit for you. Then we create a defense. What is a defense? I'm going to get into more details on it, but the defense keeps you from losing. This keeps you from making the bad decisions that get you in trouble. And so we're going to go out, we're going to protect against losing. Then we're going to create an offense so we can start winning. Then from there, we go out to a product marketplace. So what we have, we're very similar. If you were buying and spending money, you would open an Amazon account. And when you open that Amazon account, you can buy anything. Well, what we have is we have products and selection that goes across all things, all right, when it comes to money, everything. And then we can look around and find things that fit you at your time in your life. And then the last part that I believe is the key element is you review and update it. So you earn more money, you inherit money, you change jobs, you have a kid, a new kid, or whatever it may be, get married, get divorced, all the things that come about in life. And then what we do then is we update. All right. And we make a little adjustment here. You get a better job, make more money. We're going to do something different. And so that's kind of the way that we work and put together what I call automatic financial independence. So the defense component focuses on protection, preservation, minimizing your risk. It ensures you have a solid foundation and safeguards against financial setbacks. The offense focuses on growth, wealth creation, seizing opportunities, and it positions you to reach your goals and financial independence. So we're going to cover this whole thing. So what makes up the defense, a good defense? Well, it starts with what we call a GPS. A GPS is very simple. If you think about it, you get in your car, you pull your phone out. And I remember back in the days, when I was young, you'd pull a map out and you'd look and you'd figure out where you're going. It didn't tell you, hey, just somebody didn't talk to you and say, turn left in 200 feet. You had to look at the map. You had to go figure all this stuff out. Well, the GPS, when it comes to your money, is your goal, your plan, your schedule. So how do we do something like that? Well, what does the GPS mean? It says, well, I would like to quit work one day and have, in addition to possibly Social Security, I would like to have $100,000 a year. That's what I want. I want $100,000, do nothing money that I know is never going to run out. What do I need? Okay, $100,000 is my goal. 20 times that, you need $2 million. All right, so now we got that figured out. So 2 million is $100,000, and then we got to inflate it. Every 20 years, you got to make twice as much. And so you got 20 years to go. You need 2 million, you need 4 million. all right? And you say, I've got this much and I'm going to invest this much per month. I'm going to hit my number. That's my financial independence number. We then build a budget to hit that goal plan schedule. We have an emergency fund to keep us from going backwards. That's 3 to 6 months of liquid cash. We understand the difference in debt. What is good debt and bad debt? Real simple. Good debt, you can afford it. It's tied to something that goes up in value. Bad debt, you can't afford it. And it's tied to something that goes down in value. We buy insurance. Okay. The insurance portion is life insurance, which is income protection. All right. And it's also used for final expenses and things like that. You have health insurance to keep you from, it's asset protection. So life insurance is income protection for the most part. Health insurance and liability insurance, home, auto, things like that, are asset protection. So we protect our income and our assets. And then we get a mortgage that we can afford. And we use things like second mortgages, HELOCs that when we don't need them, we get one. So therefore we can have an additional emergency fund. That's our defense. So now when we put all that in play, typically speaking, about 5% of your income should go towards your defense. All right. So if you're looking at a good defense, it's about 5%. All right. Now let's look at the offense. This is where it gets fun. We pay ourselves first. We have an automation where we don't work our whole life without a profit. All right. I mean, you think about what if you work your entire lifetime and you're 60 years old and you look and you say, you know what? I got no money. All right. So that means you worked without a profit. So what we want to do is want to make a profit. So one day we can get what we call do nothing money, or making money while we sleep. All right. So the money works. All right. We take advantage of compound interest to get better rates of return. We consistently invest and use time. We diversify our money. We buy different funds, either mutual funds or managed accounts. We allocate it based on our age and our time horizon coming out. We look at tax planning when we're earning money. What's the best way to reduce taxes when we're pulling money out? We maximize retirement plans, matching funds, things like that. If we have children, we want to send them to college so that without student loans. I remember when my daughter was 33 now, when she was born, I opened a college fund. I was so excited about it. And I was able to pay for her college as a result of that. It's called planning. Then we have annuities, which are products that give you lifetime income. We look at income planning. All right, where are we going to pull money from when we retire? Then we have estate planning and charitable giving. That's the offense. So now we're moving in a positive direction. From there, we put that money in different places. So what we're doing is we're bringing our money in the door, and now we're going to put it in different spots. We got emergency funds. That's to keep us from having to borrow money or go in debt. All right. In the event we lose a job or we have some kind of accident, something like that. We have retirement funds. Those funds are designed for retirement. That's why you put them in, and they penalize you if you pull out prior to that. So we want to make sure that we maximize our retirement planning. We have college funds where we can put money aside for tax-free growth. We have opportunity funds. What are they? That's liquid cash that's invested, doesn't have an earmark for what we're going to do with it, but an opportunity comes along. We have access to it. It's growing, but we may have a chance to buy a business, or maybe we have a chance to buy some real estate at a cheap price that we want to do so, whatever it may be. But it allows you to have access. And we have non-retirement tax deferred funds. Those are annuities where we can throw money in, let it grow forever, without paying taxes until we pull it out. An example of that would be, or a way you think of that is, why would I pay taxes on money I'm not using? Because if I have money and I'm paying taxes on money I don't expect to use, I'm having to work to pay for my money. That doesn't make sense, right? So what if we could defer that, where not only do you not pay taxes each year, you get to earn money on the taxes, the deferral that you didn't pay. So what that means is, rather than sending it to the government, the money's still in there and it's growing. And then we have funds for income when we retire, and we have funds for healthcare. So there's 7 areas that we discuss, and we're going to discuss all this kind of stuff as we get moving here. And then we go out and we buy products. And what we do is we go match products like life insurance, term and permanent insurance, and health and disability insurance, fixed and indexed annuities, wills and trust. I want to talk about that in just a second. I ask people, do you have a will or trust? And they, no. Okay, we know the answer is 2 out of 3 don't. And they all say this, I need to get one. I need to get one, especially if you have children, stuff like that. We'll talk to you about that as we go throughout. Then we go on the offense, mutual funds, ETFs, that's called exchange traded funds, managed accounts, annuities. And in many cases, we have retirees that utilize a mortgage in order to access their cash. And so with that, that's kind of the overview. What I'm going to do is turn to Jake. You want to take over, introduce Joe, and then we're going to jump on the defense.
Yes, sir. All right. So, by the way, I meant to say this, guys. We have a chat feature in the webinar. If you have a question you want to get answered, stick it in the chat over here on the right-hand side. We'll answer those questions as we get to the conclusion of the webinar. Next up, Joseph Osborne. Joseph, tell us how long you've been with the Roy Mountlock organization, where you live, that sort of thing. Just give us a little bit of background. And then Joe is one of our accomplished, he's at it every day and does a great job with his clients. Joe Osborne.
Hi, thanks, Jake. Yeah, hey, I'm Joe Osborne. I've been with Roy for about 6, almost 7 years now, going on that. I actually came out of the healthcare world. So, when Roy talks about healthcare costs and healthcare opportunities, that is something that I spend a lot of time in discussing with my clients. So I really enjoy getting to focus on that part of retirement planning when we do things. Today, we're going to cover a little bit on side here. So just like Roy said, we have the GPS, the budgeting, the emergency fund, the retirement funds, life insurance, health insurance, liability insurance. So we're going to dive into this just a little bit, kind of the core components of each thing, and talk about opportunities there for us to get to the next phase of life. Some people on this call may be thinking, I don't even know how I should invest because I can barely pay my bills, or my credit card debts are stacked up. Or they're not planning for any issues along the way. It's innate that things are going to come up. Healthcare costs are going to come up. Life insurance, disability, those things. So we want to make sure that you are protecting the defensive front. I'm a huge fan of football, right? And I always tell people, defense, they win championships. When you watch football games or baseball games, right? In baseball, the pitching gets really broken down. You see the batting averages drop drastically on everyone hitting, just because the defense gets so much better. They really focus on that because they know that's the important thing. So defense may not win the game, but they're definitely not going to lose you the game, okay? And they're going to put a stop loss on there to protect you from going too far down. So we're going to dive into that. One of the first things I always like to kind of talk to people about here is every purchase has an opportunity, okay? So, when we go out and we spend $3 on a cup of coffee, that's a small cup. And these rates in the environment in Starbucks today or any coffee shop, that's just not $2.95 might get you a water at this point. But if you look at it in the first year, you've spent about $5,384. So if you take that money that you're spending every year just on coffee and you invest it, right? We just take that money, instead of putting away, we're going to invest it. And over time, over a 40-year period, had you enjoyed your coffee every day, you would have been down about $43,000. That's what you would have spent. But had you invested that in the market, it's $177,000. So when I sit down with clients, the first thing we talk about is in their budget is where can we cut back costs? Where are we overspending? A lot of times that comes down to eating out. That's probably 95% of what I see is people excessively eating out, or it's convenient. I'm just as guilty. I have 3 kids, and I'm just as guilty of that. And so eating out is one of those things that can get you. And so that's usually where the budget plays for people. But looking at opportunities for us to cut back and where can we save more money. Some people say, I'm strapped, I don't have enough. There's always some wiggle room there. We just have to be willing to give up some things for a short period of time to get to our long period goal. So I always like showing this, just kind of shows you really the different spread between if we keep spending versus if we turn that switch on and start saving. So when we look at financial goal setting, so the first thing we do is we set goals, right? So I'm a big goal guy, right? I always tell people they have to be measurable. They have to have a time horizon on them, okay? And so then they have to be important to you. If they're not important to you, you're not going to hit them, even in your finance, right? But as I've gone along and I've done more goal setting, I realize that as important as goals are, it's the daily inputs of things that we do every day to get us there. Okay. So let's say you want to save 50,000 for a down payment on a house. Okay. Or maybe 50,000 on a beach house. You already own your house. You want to do 50,000 down. You have to be willing to set aside $850 a month. After 5 years, that will get you there, right? But if you're not measuring that, that 850 might be 250 in 1 month, or it might be 0 1 month, right? And you're going to look up in 5 years and say, man, we don't have enough to buy that beach house, right? So it takes the consistency and the discipline to get there. The next thing you want to do is you want to prioritize your goals. Okay. So we start with assets and liabilities. Okay. So I always tell people assets minus your liabilities is your net worth. So sometimes our liabilities are greater than our assets. Therefore, we have a negative net worth, and that's okay, right? Especially when you're starting out, you're going to have that. So short-term and long-term goals, right? So paying off credit cards, right? Trying to stay out of credit card debt, building an emergency fund up, just like Roy was saying, 3 to 6 months. That'll kind of prevent you from having any issues or a job loss, right? Then you want to talk about saving for retirement. Very important. Adam, Jason, Dave, they'll all dive into that a little bit more. I won't spend my time on that, but it's going to be incredible knowledge for you guys, and you guys will see how it all works together. Then buying a home. Okay. So if you own a home, you don't own a home yet, you want to get there, then let's talk about setting that together. So you have to focus on the goals that are most important to you, because if you don't, you'll just never achieve it. Okay. And I always say list them in order. Okay. And if you're in debt, in credit card debt, that should be your first list off the list. Okay. And then we want to monitor our progress. So a great example, my wife and I, we do a monthly meeting every month. And so we sit down, we talk about our finances, we lay out our goals, and we see kind of what's changed. Have we brought on a new expense? When you have 3 kids, expenses just pop up, right? We also talk about other opportunities that might be out there for us. We actually track on a ledger. We kind of old school that way. We track our budget on a ledger, and we do use some computer software at times. But for the most part, we like paper. We like to see it in paper. So find a system that works well for you when you're setting your goals, and make sure it's something you guys are actually going to stick to. In this day and age, a lot of times that is technology. Like I said, my wife and I are a little old school. We like paper, so we do it on paper. Okay. So we talk a lot about budgeting and cash flow. So how do you assess what you really have at the end of the month, right? So a lot of people, I find, I'd probably say 85% of clients don't do this when I sit down with them. And they don't realize what they have coming in, nor do they definitely not know what's going out. A lot of times I'll ask people and say, well, what do you make per month? And they kind of look at me and they're doing the math on their fingers. They just don't know, right? And that's something we have to know, right? If we don't know it, we control it, right? And so we really have to think about, okay, what income sources do we have? And we list those out. Okay, maybe you make 10,000 a month, right? And then we take out our regular expenses, so things we have to pay, housing, grocery bills. We also have entertainment in there. Okay, I listed that just because we've got people enjoy having fun and doing some things. Okay, and this will really give you a good idea of your monthly cash flow. But one thing I tell people here is we want to make sure we're realistic in this. Don't say, "Oh, I can cut that out," or I don't spend that much. Really go back and look. Go back and look and see what you spent. It'll really give you a clear picture moving forward. You'd be surprised by how many times you say, "I didn't really spend that much," and then you go back and look, and you're like, "Ooh, maybe I spent $700 this past month on it," right? So really get that under control and see what you're doing there. Okay, so be very realistic in that. So also, once again, with being realistic, we want to make sure we're realistic with the budget as well. Okay, where can we really cut out, and where are we willing to cut out, right? If you say I'm going to cut $500 a month off and eating out, and you're not going to, don't put it on there. You want to make sure you're budgeting it so you can really see what your cash flow is. And at the end of the month, at the end of the week, if you're paid weekly, however you choose to do this, you have to have a surplus, right? So we want to cut back on all those things that we can cut back on, whether that be streaming services, eating out, additional entertainment, right? You'd be surprised by how many times people, one of their biggest budget blowers is stopping at the gas station for, Twinkies and a soda, right? Adds up after all. If you're spending $6 a day, 30 days in a month, it adds up. Okay. So be very, very realistic on that. Okay. And we want to make sure we're saving more, okay, and spending less. So we want to set aside that emergency fund, like we talked about. A lot of life adjustments can come up that were unexpected. It's just kind of the nature of life. Okay. And then the last thing, Roy touched base on this real briefly in passing, but one thing we always talk about with people is one thing you do is you can have an home equity line of credit. Okay. It's called a HELOC. And the way that works is you go to a bank and they're going to give you the equity you have in your home. So let's say you owe $200,000 on your home, but your house is now worth $550,000. They're going to give you a line of credit up to probably about $150,000 to $200,000, depending upon the bank, right? And so what this does is you can open it. It doesn't cost any money to stay open. And in case you lose your job, you have an automatic emergency fund. Yes, we're going against the equity in the home, but you're only paying interest back on those things until you get back on your feet. And then you can pay more and get it back down to zero. Okay. But no bank will give you this HELOC if you don't have a job. So it's important to do it while you have a job. And I always recommend to people, shop around for HELOCs. All my clients that do it, they never pay a fee to do it. There's no fee to open. There's no fee to appraise. Find a bank, credit union that'll do it for free. If someone is going to charge you for that, then it's definitely something you want to do. Okay. So that's really a great way of using HELOC. Okay. There's some other reasons, other ways we'll get into it along the way, but we'll talk about it. The other thing too that goes along with HELOCs is if you're older, on the reverse side of it, you have a lot of equity in your home, you can actually do what's called a reverse mortgage. And what that does is allows you to tap into your equity. Okay. It pays off your mortgage so you don't have a monthly payment. Okay. And they'll give you a lump sum that you can invest and pull income off of. So let's say, for instance, you make $5,000 a month off of your Social Security and your investments, but your house payment's $3,500. And that leaves you about $1,500 left for everything else, which isn't much, right? We could do a reverse mortgage on the house, wipe away that $3,500 a month off of your outgo every month. Okay. You still own your home. You'll always own your home as long as you live there. Right. And there's a chance your family will still own your home when it's all said and done. Okay. And so, but the way that works is now that $3,500 is off. So we now just gave you back $3,500 a month. So there's a lot of flexibility in the way we do those things. Very case specific, but it is another strategy we use for people. So when we look at debt management, we want to list all of our debts out. We list them in order. It doesn't matter what order. But there's three things I always have people write down. What is your minimum monthly payment? How much do you owe? And what is your interest rate? Okay, so your monthly payment, how much do you owe, and your interest rate. Okay, and we like to focus on paying on the higher debt first. Example, credit cards are usually pretty high. Personal loans aren't as much. Student loans aren't as much, but those credit cards will get you. And if you have a credit card, you've seen your interest rate climb in the past 2 years with the rate increases, and they're going to hold for a while unless someone comes in and does something about that. But we want to get those down, because if we're paying almost 30% of interest on that every month, that's going to be very, very challenging for us to pay down, and it will be chewing out a lot of our monthly outgo. So there's a couple strategies you can use, right? So there's the debt stacking, the debt snowball, whatever you want to call it. One of them is you pay off the debts with the highest interest. Usually that makes sense the most, but it'll save you the most interest being paid. But sometimes paying off the smallest amounts and moving along to the larger amounts does a psychological thing for you. So it helps you stay on pace, helps you feel encouraged. If you pay off a $2,000 credit card, you feel like you have some momentum, you feel like you have a win. But if you drop your credit card, maybe a loan from 30 to 28,000, you still feel like you have a lot of debt, right? So sometimes it matters if we just stage step up from the bottom up, just to keep people going. You know, we'd rather have people going and paying it off, even if it's slightly less efficient, because they're going to keep going versus doing it the other way, and them getting discouraged and just throwing in the towel, you know, 6 months in. So there is a psychological component to that. So just figure out what strategy is going to be best for you and what you're going to stay to. Okay. Consider refinancing, consolidating. So you consolidate your loans down, higher interest rate down to lower interest rate. Some people even do this with HELOCs, right? Their HELOCs might be a 7% interest rate, but their credit cards are 30. Sometimes they'll take some of that HELOC off, take the HELOC, pay off the credit card, and get rid of the credit card. Now, when people do this, I do warn them, you have to be careful on your spending. Don't continue to spend on your credit card again and run that back up and be like, well, I'll just pay it off with a HELOC again, right? You're going to get into a vicious cycle now where you're running two bills up, right? And then you're going to get even more buried. So just like debt stacking and snowballing works one way, it can definitely go the other way if you're not conscious of it. So you have these strategies in place with debt management, though, where you're budgeting, you're looking at your outgoes, your ingoes, and you're prioritizing paying off your debt. You're going to be okay. Okay. You just have to be careful of that. All right. So the next part of the defense is insurance and risk, right? So we're trading a little bit of things off, right? Anytime we're talking about insurance, we're trading off. It's kind of just in cases. Okay. So the first thing, we protect your income. Okay. When we're younger, sometimes older too, term life insurance really provides that. It's a low cost, high amount of payout in case something happens. Typically, we recommend 10 times your salary. So if you make 100,000, yeah, we do recommend you have $1 million policy on you. Okay. You know, if it's a non-working spouse, I like to try and get as much coverage on them as possible. For instance, my wife is a stay-at-home mom. She works incredibly hard. I promise you, if something were to happen to her, $1 million wouldn't replace that of what she does with her kids day in and day out, right? So definitely take into consideration, just because someone may not be bringing in revenue at that moment doesn't mean that their life's not worth something. So definitely consider that, even if you have spouses that aren't working. Okay. Make sure you have adequate amount in place. So and then we also talk about health insurance. So one thing with life insurance to see is maybe they have it through work or whatever, and it's one time their income, and they say, you know, that'll be good for my spouse to get back up on their feet. And I said, well, obviously you've never lost someone, because the grieving goes well beyond 1 year, right? And now they're having to worry about bills coming in, doing these things. So a lot of times I sit down with clients and I meet with them for the first time, and they might have life insurance, but they're well underinsured. So make sure you're up to that 10x mark. And I'll show you just something here in a minute that kind of shows you kind of what that looks like on a giving out of money when you pass. Then we talk about health insurance. So, you know, this is something that everyone is kind of a no-brainer for a lot of people, thinking, well, I need health insurance. We all know health costs are just going up, no matter what age you are, whether you're born. You know, I paid $6,000 for my son's first, you know, my son's birth back, you know, 8 years ago, and then all the way to retirement and beyond, right? Healthcare only goes up as we age. Okay. So we definitely want to make sure we're protecting us against any catastrophic health risks. Okay. The other thing too is, if you're self-employed, you can go to an exchange. There's other associations you can be a part of that will allow you to get health insurance, but we want to make sure that we're protecting it. Even if we're healthy and well, we at least want to have a policy that has a stop loss there for us. Usually those are around 12,000, but it's still a stop loss for us, and we want to make sure we have that. Disability insurance. This is a lot of times people get coverage through their employer for this. This is in case you can't work, right? In case you're injured or you come with an illness, you have to be able to cover your expenses. So disability insurance plays a part in that. It's very, very important to have, because if you get separated from your job for any reason, you want that income stream coming in, because you still can't provide for your family without it, right? So even though maybe your life insurance pays if you die, right? You know, what happens if you become disabled and you can't work, right? You've got to have that coverage on you. Okay. Then we protect our property. This is a no-brainer, right? If you have a mortgage on your home, you have to have it, right? So you have to have homeowners insurance, and this, you know, for our cars as well, at least some type of coverage. Liability usually is the minimum they'll grow, and you want to raise your deductibles as your assets grow. Okay, so as you have more money, you can easily raise your deductible. So instead of paying $1,000 in case something goes wrong, you could pay $2,500, and that'll lower your premiums every month to be able to replace your property. Okay, so definitely something to talk to an insurance agent about, but you want to make sure you're properly protected, umbrella policies, all of those things. And then we also talk about secure personal liability insurance, like I just said, an umbrella policy. So if something were to happen to you, your assets are still protected underneath that umbrella policy. They can range pretty much from any amount of money you want that you're willing to pay for. And usually those are written through your same people who do your property and your auto insurance. So make sure you have that layer of extra protection involved to protect you against any lawsuits or anything that comes in. Okay. Okay, so next thing we're going to talk a little bit about is combining term life insurance, IULs, living trust to secure family's financial future. So there's a combination we can do here with that for you and put them together, okay? And then bind these three components together, okay? You can ensure both short-term and long-term financial protection. So on the term, it only lasts for so long. The index universal life, it's more permanent, lasts with you forever. So as we age, let's say we get into our 60s, 70s, we still need that insurance. It's really hard for us to get, especially if we've been sick or have heart issues or anything like that. It just makes sure that we're protected both on the short term and the long term of our financial future. Okay. The other thing too, it helps build wealth over time by managing risks. Okay, so the unique thing about the index universal life is it is a life insurance policy. There is cash value that is growing in there. Now it grows at a very conservative rate because it is an insurance. Okay, so we don't look at that as really as an investment per se. But as time goes on and you do have amounts, cash value in there, you can actually begin to take loan distributions against that if you want to get tax-free income off of you. Okay. And it helps protect and control distributions of your assets. So it really does diversify you out to protect them. Okay. So why combine term life and IUL and a living trust? So like I said, term life is very affordable right now. Temporary coverage hits our needs. Okay. IULs, like I said, they have the opportunity for cash value growth. Okay. And that money can be taken out tax-free as time goes along. Okay. We also have a living trust that ensures that our assets are managed and distributed according to our wishes to avoid probate and offering any additional control and privacy. So, one of the last things we want to see is that if there's not a will or a trust in place, it goes to the state, and you can actually go online and look up that the cases in probate, right? So there's plenty of people in probate right now, and everyone kind of see what's out there. So it really does protect your loved ones after you pass to make sure that no one else can see what's in probate. Okay, and combining all three strategies really will help you hit your goals for your future, protecting your assets, your family, and giving you a little bit of flexibility there towards the end. Okay, so I always tell people, if you don't have a living will and trust, all my clients have one, unless they haven't done it yet. But I make them. It's something that is on the top of my priority list, just because it seems excessive, something we don't talk about down the road, but it is vitally important. Okay. So the benefits of the term life, okay, like I said, it's affordable. You can get them up to 30 years. Anymore, you can even get some of them, if you're healthy enough, up to 40, depending upon your age, 40. I even saw one company now writing 45 years. Okay, now you're paying a lot more for those. Not my recommendation usually, but it is a case-by-case basis. It's ideal for covering short-term financial obligations. So when our kids are young, we have a mortgage. It really is income replacement. So if something were to happen to me, my wife's stay-at-home mom, she's incredibly gifted at it. But happened to me, that income would just be gone, right? So she's got to have an income stream to be able to subsidize that. And I'm still young, building assets. So it does matter for me. Okay. And we look for the lowest cost for you to get the highest death benefit. So it's a trade-off. And you'd be surprised by how inexpensive life insurance is. One thing that a lot of people think is that life insurance costs an arm and a leg, and it really doesn't. Especially if you're healthy, it's very, very affordable and it fits in every budget. But it is something that needs to be on your budget line every single month. And it needs to be separated from your job. One thing I tell people is that you need to have a separate policy away from your job. A lot of people say I'm covered through work. I pay $2 a month on that, or $2 a paycheck for 500,000, and that's fine. But one thing I do tell people is that, if you were to leave that job, that doesn't go with you. Or if you were to get into an accident and you get separated from your job for any reason, you no longer have that benefit. And you're probably going to have a hard time getting life insurance outside of that if it was a health issue that you got released from your job for. So just things it's important for us to be able to do. Okay. So the benefits of the index universal life, lifelong coverage. Okay. Like I said, it doesn't go away. It'll be with you until you die. Okay. So later in life, you need life insurance. Usually terms going to be very expensive or it's going to be almost impossible to get. So you can do guaranteed death benefit for your entire life. Okay. One way for this is I tell people is that I actually have companies that'll come do guaranteed issued whole life. I did this for my mom, right? So my mom's not in great shape. She's kind of near the end, but I know she has a lot of health issues. She can't get life insurance coverage. But me being the responsible son, I'll be the only one that'll be paying for her funeral costs and those things. And so I want to protect my own assets. So I actually insured my mom off of one of these to make sure that I can cover her death benefit. Okay. So, and that'll be with her for as long as she lives, and I don't have to worry about anything. Okay. But there's, whenever you do an IUL too, there's also cash value accumulation. So at younger ages, you put in a little bit along the way. Every month, it's like contributing to both a life insurance and a cash value accumulation side. It grows based on the stock market index with some downside protection. So the positive thing about this is that your cash value never goes down. As long as you're not pulling from it, it never goes down. Your cash value cannot go down. Okay. So if the market sinks 30%, you don't realize that loss. Okay. Now, on the flip side of that, if the market goes up 30%, you may not participate in all of that 30% up. Okay. So it gives you protections. There's a trade-off on the other side. Okay. There are a lot of tax advantages to this. And this is where we talk to a lot of our clients about utilizing these for tax advantage purposes. So it gives you tax deferred cash value growth. Okay. So it'll keep growing and growing and growing. You're not paying any money on those gains. Had it been in another account outside of that, just a regular non-qualified account that's not protected by the IRS code, it'll continue to be taxed every single year. Okay. The other benefit is when you pull from your policy, you're actually doing your withdrawals as a loan, not as cash receiving. So because it's coming to you as a loan, it's completely tax-free. Okay. That's a huge benefit, especially in retirement, because if you're about to move in the next tax bracket, you can pull from this and not be taxed. You can still keep your taxes minimal or next to zero if you have the right setup. Okay. You can do adjustable premiums and death benefits to a change in your needs. So let's say right now you need more coverage for your kids because you're younger. As they get older, they don't need as much. You can change those death benefits and change your premium. So it gives you that flexibility to pivot as life pivots with you. Okay. So with the term, you're married to it until that term is up. You can cancel anytime, yes, but it's going to be the same price every single month. Okay. With these, they can be set up where we can adjust those premiums and have some flexibility within them. And it really does help cater to your needs as we move and as is more nimble. Okay. And then it provides death benefit for critical and chronic and terminal illnesses. Okay. So a lot of life insurance policies will give you a terminal illness benefit. That means if you were to get cancer or you're about 6 months to live, right, they will pay out up to a certain percentage of your life insurance policy while you're living. Okay. You can do whatever you want with that, pay off debt, go on trips, seek alternative coverage, whatever it may be. But one of the big things I tell people is the critical and chronic illness. So what happens if you have a stroke and you can't work? Or what happens if you have a heart attack and now you're limited? Or what happens if you have a cancer that's just wiped you out over 12 months, but you're going to recover, right? And your medical bills are just stacking and stacking. And if you've ever had any of these things, the medical bills, right? Even though we have health insurance like we talked about, we want to keep climbing that. Okay. That's where the critical and chronic illness benefit come in. It'll pay part of your death benefit, even though you're going to live and you're going to do well and you'll be okay. Your life has definitely changed. There's no question about that. But most policies will only pay after you pass, right? This allows you to protect your family and absorb some of those financial burdens while you're living and don't have income. Okay. Huge component that is easily overlooked. Okay. So when we look at our costs, how much coverage do we need? Determine our coverage when we look at term life. Okay, so an easy look at this, it's a lot of numbers. Okay, but I'll break it down for you real quickly. So we're going to assume that your income objective is about an 8% of your policy. Okay, so let's say you bring in 6,000 a month over here. Okay, and you want your loved one to live for 20, 30 years with it. Okay, you're going to need about $823,000 in life insurance. Okay, let's say you're like, hey, my spouse doesn't need this for very long, just get me through grieving, and that's what you choose to do, then you can do 6 years for 6,000 a month at 344,000. Now, mind you, this is assuming 8%, could be more, could be less. This is just an average table for us to begin to kind of have a conversation about how long we want to live, and leave money behind for our loved ones, right? So if you make more than this 6,000, we have to extend the table out a little bit, and go beyond there. Okay. All right. So our protection plan that we do have in place, like I said, we review income protection. Okay, that's life insurance. Okay, we talk about retirement protection. Dave, Adam will get into that retirement protection. I'm not going to dive into that. Okay, but remember one thing about retirement protection is also like our umbrella policies, our chronic and critical illness benefits, right? Things that are going to protect us from tapping into our retirement too early. Then we have lifetime income. Okay, we'll dive into that a little bit later. Long-term care. Okay, I love this, but Dave and Adam will talk about that a little bit later. Final expenses. Okay, that's kind of like I talked to you about with my mom, right? A final expense policy. It's protecting my assets personally to protect her. But on the flip side, if my mom had a lot of assets, it would protect it because it would pay the estate taxes. If she had a lot for me to take over and inherit, I would want some life insurance on her to cover the estate tax. Okay. And the estate plan, like I said, that's where the life insurance comes in. We talked about IULs being with you for life. Okay. Later on in life, especially when you're 80, 90, you're just not going to be able to get life insurance except for a small death benefit amount. But if we set that up early, later in life, we'll have that. And that will ensure that all taxes are paid for our loved ones. And that they're safe, and that the wills, the trusts are there to bypass probate. So it's really going to protect our family on the back end.
Joe, great job, brother. Appreciate that. I hope you guys took good notes on that. I will say that if you have a question about wills and trust, we do have a strategy where if you place either term insurance or final expense policy, we can cover the cost of a will and a trust for you. And so saves you probably $3,000 to $5,000. In fact, we just talked to one of our business, one of our business partners. It was a guy that serves insurance for us, and he said, "Yeah, I've been thinking about getting one." He gives us the same answer as everybody else. So get with your person who advised you, ask about that strategy. All right, and then one other thing, guys, I want to plant a seed. Joe on here and Jason coming up. These guys started part-time in our business as a referral partner with our company, and then later on decided they fell in love with it and got good at it, and they made a career out of it. And so if you're sitting here thinking, wow, this is all great stuff, think about it from a different angle. We are looking for referral partners right now. We're growing our company. If you're like, well, really, I could be involved in something like this? Yeah, what better way to be an expert about your own money is learn how to do it as an advisor. And so you can start part-time, not take any risk. And we have a great program to do that. So next up, Jason Ogles. Jason, good guy, lives here in town with right down the street from me, figuratively. We're right around the corner. Jason, tell them a little bit about your background and how long you've been in the business, and then take it away for the next part of the presentation.
Yeah, sure, Jake. Thank you. Well, time flies. So it's been, I guess I got started with Roy back in 2001. I'd gone to school to be a history teacher. I thought, had an economics minor. So I didn't really know what I wanted to do when I graduated after going through all that. Kind of ran into this business by accident through a friend's introduction. And, he showed me some of the things that hopefully I'm going to convey to you guys with the offense today that really hit home with me at the time. I was young, And kind of like Roy said, I was pretty stupid with what I was doing with money. I was blowing it left and right, being 25 and single kind of happens sometimes. So anyway, what I found was a lot of these concepts I really fell in love with, and I think they can really help people. So here we are later, and I'll get into this. Let me start sharing my screen. All right, so I'm going to cover the beginning of the introduction to the offense. So, with like Joe said, without a great defense in place, it really makes it hard to win. So, if you implement some of those concepts and things that he taught, once you do that, then you can start looking at these things. And really, basic concept, kind of an introduction to investing. Adam and Dave are going to go into more in depth as far as the types of accounts and the nuts and bolts of how those things works as far as tax benefits and all. But the first thing that I'm going to talk about here is using time and consistency. And what that means, really, if you have time on your side and you're trying to hit a goal financially, it's a much easier the earlier you get started. Uh, and also consistency. Sorry, I need to move my screen here. I've got Jake's big head up in my way here, so bear with me just a second. Get it at the bottom, that's better. So dollar cost averaging means investing your money in equal portions at regular intervals. So it takes the emotion out of that. Whether you hear the news, it's good or bad. If you have your money set up to go into an account automatically that you're saving for a particular goal, the emotions removed from it, and you don't really have to give it a second thought. You don't have to have eyes on it all the time. So dollar cost averaging, like it says, can help you manage risk by just following a consistent pattern of adding new money to your investment over a long period of time. It's kind of like I'm looking out here, my backyard. We've got this little creek, and if you go down to it, there's not a lot of water that normally runs through it, but it's cut down into the bedrock rock over, you know, thousands of years. And for that little amount of water that normally runs through there, you would think, well, how did it do it? Well, it's always running, and it's had time on its side. So it's very similar to that when you're investing, having time, consistency, and getting started early. What this shows you, one of those stupid mistakes that I made early on with my money before I knew better is I remember in 2001. I got started with Roy in May. Well, in March, I'd gone out and bought, well, I financed, I didn't buy it, I financed a Z71 four-wheel drive truck, brand new, and my payment, I'll never forget, was $502.70 a month. And, it's a great truck, loved it. But when I saw what that could do a couple of months later, I knew right then I'd messed up. So this example for you guys that may be starting out or looking at starting something, $500 a month. If you were to take that money and invest it, and let's say you got an 8% return. Well, if I'd done that when I was 25, 40 years later, at age 65, which I'm not quite there yet, getting close, it would be a little over $1.7 million. Okay, which is a pretty impressive number still today. $1 million can be quite a bit of money still, even with all the inflation and things that are going on. But if somebody were to wait, let's say, I've got other things I want to spend my money on. It's really not that important right now to get started. If you were to wait 10 years and you started and only had a 30-year period to save that same $500 a month at 8%, you're only going to have $745,000. It's going to cost over $1 million. So, one of the things that try to teach with people is, and I remember hearing this early on from Roy, is how many $1 million mistakes can most people afford to make in their lifetimes? And the answer to that is not a lot. How many do you want to make? Not a lot. So it always pays to get started as early as possible. I know we've got a lot of families on this morning with their kids and all. So if you get one or two things out of each one of the people that talked this morning, look for that. I know we've got a lot of info shooting at you, but maybe just make an effort to glean one or 2 points. Maybe this could be one of them for you. Put that in the back of your mind. And then I'll feel like I've done a good job in talking with you. The next thing is, why is rate of return important? A lot of people just don't realize, even if they're saving money, they might not have it in the right place for the goal that they have in place. It might not be getting a competitive return. So this was one of the concepts that was so powerful for me in making a decision to make a career out of this. It's called the Rule of 72. And it's pretty neat. If you like math, this is a pretty good one to remember. But it's just a simple calculation that shows you how long it takes to double your money based on the interest rate that it's growing at. So if you look right there, it says, how does it work? You take 72 and you whip out your calculator if you're like me, and you put in 72 divided by your interest rate. In this example, the first one here, it's 1%, and 72 divided by 1, it's 72. So it would take, let's say if you had $1 sitting in maybe a savings account or something, getting 1% checking account, it's going to take 72 years for that dollar to turn into $2. And that's pretty basic. I like basic concepts like that. Pretty powerful. So a few more down here at the bottom. Some examples. The 4%. 72 divided by 4 is 18 years. Where would you find a 4% return on your money? Well, maybe like a money market account or a CD, a certificate of deposit at the bank or your credit union. Historically, that's what those things may have paid. Interest rates as of late have been a little higher, so they've got a better return. But at 18 years, you can see over 48 years, your money's only going to have time to double a little over 2.5 times. So you would end up with your $1,000 being worth about $6,000 48 years from now. Same thing, maybe you get an 8% return on your money. Well, that could be, like a savings bond, a bond fund, something a little bit better rate of return than the savings account. 72 divided by 8 is 9 years. It's going to double a little quicker, going to work a little harder for you, and you're going to end up with your $1,000 growing to 41,000. A little better return. And then at 12%, 72 divided by 12 is 6 years. It's going to double 8 times in 48 years, and you're going to have a little over $250,000. So where do you find 12%? Well, if you're like me, when I got started, I said 12%. Sounds great. Nobody's ever talked to me about getting 12%. Never heard of that. That's just crazy. Well, that's what we teach people how to find, and that's historically like what the stock market and mutual funds, things of that nature, have returned. And if you have questions about that, that's something that we can show you. But the 12% at 256,000, you can ask yourself, or maybe sit there and ask your kids, in 48 years, would you rather have $250,000 or $6,000? So pretty easy question. All right. And so then tied into the Rule of 72, another concept that we've used for a long time with people is becoming an owner, not a loaner, and earning the spread. So what does that mean? Well, if you're not familiar with investing, what you may be doing, or what your friends or family may have done with their money, is that you take your money and let's say you stick it in the bank. Well, the bank pays you an interest rate for having your money in the savings account, or maybe the checking account, or a CD. And what they've basically done is then they turn around and use your money. They lend it out to other people or other businesses, and they may make anywhere, or on a credit card, anywhere from 8 to 22%, and then they pay you 0 to 4 historically. Well, the spread is the difference between the 4 and the 8 to 22 that they earn. So wouldn't it make more sense to own the bank than loan your money to the bank? And if you own the bank, then you own the spread. So most people, if you're like me, when I got started, well, owning a bank, that sounds like a great idea, but how would you go about doing that? How would you know which bank to put your money into? Well, most people don't have the resources or the time to go and or the access to go down the street, go down to Main Street and go into their banker and say, I'd like to meet with the president of the bank. I've got I've got a few $100. I'd like to see about owning your bank and see if it's a good investment. So what we show how to do is invest in when somebody's starting out, a good way to do that and own stocks of banks and other companies and get the spread is through mutual funds. And if you've heard of mutual funds, they're not highly complicated. They're once you see how they actually work, it's pretty simple. And so the definition on the screen, okay, a mutual fund is a company that pools money from many investors. In other words, many investors mutually fund the mutual fund, okay? Not rocket science, and invest the money in securities such as stocks, bonds, and short-term debt, depending on the objectives of the fund. And so the combined holdings of the mutual fund are known as its portfolio. And then the investors buy shares in the mutual funds. Each share represents an investor's part of ownership in the fund and the income that it generates. So when you buy a mutual fund, you get a statement in the mail or email, whichever you prefer, and you can see if you put a certain amount of money into it, it buys a certain number of shares of the fund, depending on what the value of those share prices are of that mutual fund. And there's all kinds of different funds. I'll touch on a little bit of the different types, but the main thing is, well, I own a mutual fund. Well, how does it make money? How does that work? So there's 3 different ways that I'd like for you to keep in mind. And a lot of people are familiar with real estate, and I'll relate it to that. Maybe you own a home or you own property. Mutual funds make money really in the same ways that real estate does. First, you may have heard of dividends, and a dividend, when a mutual fund gets a dividend, they own these stocks of different companies. When those companies make money, they turn around and they pay part of that profit back to the shareholders that own the stocks. Mutual fund, same way. It's kind of like rent. The dividend is rent for owning those shares. The second way is capital gains. Maybe you buy a mutual fund and it's worth, let's say, $100 per share. And over time, the price goes up to $200 a share. You bought it at 100 and it's now worth 2. And the fund managers, the people who are the experts and do all the research into the companies to buy, they say, we think that things are turning a little sour for this particular industry that this company's in, so we're gonna sell it before the value of it goes down. So they sell at 200, you bought it at 100, and you just made a $100 capital gain. Same with your home. If you buy it at 100,000 and a few years later you decide to sell it and you sell it for $200,000, you just made a $100,000 profit, so to speak. That's a capital gain. And then capital appreciation, very similar to the capital gain. If you own a home and it's you bought it at 100,000 and it goes up to 200,000, or maybe I should say these days a million, you buy it and it goes up to 2 million, with inflation if you're around Middle Tennessee. So your home on paper is worth $2 million. You haven't sold it, but you know that it's worth more. Your homeowner's insurance and your taxes knows that it's worth more. That's capital appreciation. Same with a mutual fund. If you buy it at $100 a share and it's gone up to 200 a share and you still own it, that's how it shows that your account value has gone up. So no big mysteries there. And then, well, what types of mutual funds are there? Well, luckily, most mutual funds, that we sit down and show people when they're getting started, they're going to fall into one of these 4 different categories. Money markets, bond funds, stock funds, and target date funds are very commonplace. If you may have a 401k at work that has these different types of mutual funds in it, if you're familiar with looking at your statements. So what's a money market fund? Well, money market funds are low risk, low risk, low reward. It says, by law, they can invest only in certain high quality, short-term investments issued by U.S. corporations, federal, state, and local governments. So there's not going to be any unnecessary losses or risk taken typically with a money market fund. You're not, on the other hand, you're not really going to see a huge return over a long period of time. Typically, money markets are something that you would want to use for, like the emergency fund that was mentioned a little earlier, or a short-term type purchase. Maybe you're going to want a down payment on a home, or you're going to buy a boat, and maybe 5 years, and you're saving money for that, and you want it to grow, but you also can't stand to have it go down. Money market might be suitable for that. A bond fund, so these have higher risks than money markets because they're typically aimed to get a little bit better return. And there's a whole spectrum from conservative to aggressive bond funds that are out there. They're corporate bonds, which are issued by companies. They're government bonds that are issued from state and local governments to the U.S. government and foreign countries and all. And these can have a very different amount of risk and all involved with them. Stock funds invest in corporate stocks, which are companies. Not all stock funds are the same. They've got a wide variety as well. And you might even think of it kind of like a speedometer. Growth funds, that's going to be toward the red line. You can have emerging growth or international aggressive growth, have a lot higher potential to grow, but they potentially could have a lot more risk than some of the others that'll come up next. But growth funds focus on stocks that may not pay a regular dividend, but they got a greater potential for the above average capital gains and appreciation that I talked about. Income funds invest in stocks, kind of a middle of the speedometer. Income funds invest in stocks that pay regular dividends. They're getting their rent payments. So maybe when the market's down, overall, those income funds still invest in stocks that pay the rent. And so you're still growing, you're still adding shares in there if you're having it reinvested. Great way to grow your wealth. You may have heard of index funds like the S&P, the Standard & Poor's 500, or the Dow. Those funds track those indexes. Then we've got sector funds that maybe you have a tech fund that only invests in tech companies, or an energy fund that would invest in oil and gas or wind, or whatever the case may be with that. There are literally thousands of different funds that you can invest your money into, depending on what your interests are or what your goals are. And that's something, if you're new, that an advisor can help you with, hopefully, if you've got a trusted advisor. Target date funds. Okay, so again, going back to maybe your 401ks, these are the I think the Department of Labor's default investments. If you're very hands off and you don't know what to put your money into when you enroll in an auto enrollment in a 401k, target date funds are typically what you get put into based on however old you are or however long it's going to be before you want to retire. And they've got a blend of stocks, bonds, money markets. The further you are from your target date, maybe you want to retire in 25 years. So that would be maybe the 2050 target date fund. Well, over time, the closer you get to retirement, the fund managers of those funds make those funds less aggressive and try to preserve the money that you put into them. Okay, they may be called life cycle or lifestyle funds, depending on what company that you do business with, and then those are available outside of retirement accounts as well. And with all that being said, if you see this visual aid here, why is it important? I'll touch on being diversified. If you look, this goes back like the past 10 years. What type of investment on those speedometers would have performed the best? Well, pretty much every year you can see the mix on there. There are different categories winning and different categories losing, so to speak. But I'll point out 2017 and 2018. If you look in 2017, the emerging market stocks, excuse me, the more aggressive ones, had a pretty decent year. They made 37%. Well, the cash, maybe like a money market, you can compare that to, didn't do quite as well. Okay. So if somebody that maybe just looking at the numbers, I won't admit to doing that back 25 years ago, plus when I had a 401k, but I do remember in my Fidelity count, I had some options, and I may have or may not have invested like this, but if it were me back then, I would have probably said, the emerging markets look pretty good. I think I'll put my money into that at the end of 2017. Probably want to stay away from the cash. Well, 2018 rolls around, and look, they completely flip. The cash is on top, and the emerging markets are on the bottom. So it pays to be diversified and not having all your eggs in one basket, so to speak. So that is the main thing that I wanted to point out there. So, all right. So mutual funds, they sound great, but what's it going to cost me? Okay. So the costs associated with a mutual fund. And the bigger, you don't have to be a tech expert to run a PowerPoint either, apparently, thankfully. So the expense ratio, what that is, it covers management fees, administrative costs, and other expenses. So it's expressed as a percentage of the fund's assets. So if a fund's return 10% over its lifetime, well, those expenses, they may range anywhere from, on average, it could be, very low to like 0.1%, all the way up to maybe 1.5% for an international fund or something that just has higher operating costs for doing business. So if it's actually returned, let's say 10%, before you ever saw that, it might have made 11. Okay, but whatever's advertised is after all the expenses. Okay, and there are typically costs associated with investing, paying for the expenses of the fund, the research, the record keeping, all those things that they do. And the way that they're taken out is typically with a retail or through a broker dealer. Retail mutual fund has a front end load, maybe an A share if you've seen those. And that's a fee that comes out. It could be anywhere, like if you're starting out, it might be 5 or 5.75%. So if you put $100 into the fund, the next day you've got like $95 going to work for you. Okay, that's a front end load. It's a one-time sales charge. There are sales or mutual funds classes that have back end loads. So you put your money in, and maybe you decide to pull it out a few years later. Assess a sales charge on the back end when you pull it out. And then there are no load funds. Okay, typically invest in indexes like the S&P 500 that don't have a sales charge. So there are different reasons that you would use those different share classes. Okay, that your advisor could help you with. What are the benefits? Why would I want to invest in a mutual fund? Well, it gives you, like I showed on that slide a couple back, it gives you diversification. It reduces risk by spreading investments across different asset classes. You have access to professional management. You don't have to try to figure out like which bank to buy. The managers that they're the nerds that's all they do is maybe on Christmas Eve when their kids are getting tucked into bed and they've gone to bed. Christmas Eve they get up, go down to the fireplace, and they open up a research report on a company they think they want to invest in, and that's their leisure time. Those are the kinds of people that are the money managers. They're very intelligent. They got access. If they want to go in and they want to, let's say they want to invest in Walmart, they'll go to Walmart, they'll reach out, and they may go interview the CEO of Walmart. They may go to Target and talk to Target about what they think about Walmart and how they compete with each other. They'll go and they'll crack open the books of Walmart. They'll go and they'll work in their distribution centers, that type of access. And so they've got teams of people that do that depending on the fund company. Well, mutual funds, they're also affordable. I was looking, I think if you wanted to invest in like Warren Buffett's company, Berkshire Hathaway, those shares of that company are hundreds of thousands of dollars. Most people don't have the ability to do that. So a mutual fund, they have very low minimum purchase amounts. Some of them are as low as $50 a month to get involved with, and so it makes it very affordable and easy. You have liquidity. So if you need to get your money, how long does it take? Well, typically the next business day at the latest. Okay. And they'll have your money sent to you. You can overnight them, or it can be linked to your bank account and done electronically. And it's convenient. Everybody likes easy. Okay. You've got simple, easy access, many asset classes, on the spectrum or the speedometer of investing. So those are some of the benefits of mutual funds. And then maybe you're a little further along, a little more advanced, professional money management or managed accounts. A couple of slides on that I'll touch on. A managed account is an investment account that's owned by an investor, but managed by somebody else, similar to the mutual fund, but maybe an additional set of eyes on that. Like a financial advisor, professional money managers do not receive commissions. So that's a difference where the retail mutual funds that I discussed on those sales charges, those typically are sold and the advisor gets a commission for that. Money management is fee-based. It's a completely different animal. They're paid based on a percentage of the assets under management. Managed funds can allow an investor to build a portfolio around a particular investing style while also receiving the benefits of diversification and professional management. And a managed fiduciary, another level of service and care is as a fiduciary advisor. So you're getting active personalized management by a fiduciary, whereas the mutual funds don't really have a requirement for someone to do that, an advisor to do that. Okay, it can be a situation where it's sold and might not be followed up on. Okay, it might not be kept up to date. The managed accounts, they have a requirement where those things they have to be looked at, have eyes on by the advisor. The fiduciary is actually legally obligated to act in the best interest of the individual investor. Same with accessibility, typically requires a higher minimum investment than a mutual fund. So the managed money, you might find that it could be $25, $50, $100,000 minimum or more to get involved with that. So it's typically a little bit more advanced for a case. And how are the fees assessed? Well, it's based on a structure, again, of the assets under management or the account value. and it can range anywhere from half a percent to up to 1.5% annually, and that can vary depending on the amount of service that a client wishes to have, the number of interactions per year, that sort of thing. No additional sales charges is seen with some mutual funds. So if you put money into a mutual fund, every time you put money into it, there's a sales charge assessed of some sort. The fees stay the same percentage, and the fiduciary standards. So again, like I said, they're legally bound to prioritize the client's best interest, making sure that instead of sitting on the opposite side of the table with the client and maybe trying to sell them something, you're more of a trusted friend. You're on the same side. Everybody's objectives are aligned with the clients, with a fiduciary. And it can also be customized depending on what your goals are, what your time frame is. Completely customized to meet the investor's goals, tax strategies, that sort of thing. And you can have inside the managed accounts, mutual funds, ETFs, stocks, bonds, individually, and other types of investments. So kind of to summarize here, again, another screen that you might want to just take a note of, get a screenshot, take a picture with your camera. These are just the key differences between mutual funds and managed fiduciary money that we handle. So the management for both, you've got professional management. The mutual funds are more of a fund level, fund by fund basis. Each one has a fund manager. They may or may not complement each other. If you have more than one mutual fund, you could potentially end up with, let's say in your 401k, you might have a choice of 5 different growth funds. They might all be from different mutual fund families, but they could have similar objectives and could potentially end up owning some of the same companies inside of each fund. And that might not be a good thing if you're overexposed to those companies. Okay. The fiduciary money, it's personalized. You've got an advisor that's going to keep their eyes out for that and hopefully prevent it, if that makes sense. So customization, no personalization with the mutual funds, fully customized with the fiduciary money. With mutual funds, the advisor is not legally required to do the things that the fiduciary is to benefit the client. Difference in fees between the mutual funds, there's a sales charge. Fiduciary money, it's just a fee, okay, flat fee for the professional services. Mutual funds, good for starting out, lower minimum investments. Managed money could be a little higher, like I said, 25, 50, 100,000 or more. And then the choices with mutual funds, based on whatever that fund's objective is, it has to invest in, let's say, U.S.-based companies that are below a certain size, or they have to be a larger size, or it's got to be companies based outside the U.S. Those are the different choices or the different objectives of mutual funds. And then the fiduciary money, they're pretty wide ranging and flexible. So the two can complement each other at different times in someone's journey financially. But with that, I'm running over on my time, so I'm going to wrap it up and turn it back over to Roy and Jake here.
Thanks, Jason. Guys, this when you're going through this stuff, it may seem like you're getting rained on and you don't have an umbrella, but we'll provide the umbrella with our advisors. Our goal is to explain to you and get you up to speed where you feel good and comfortable and confident about what you're doing. The next up, Adam, appreciate that, Jason. Good stuff. Adam Smith, again, one of our top advisors on our team. He's a fiduciary, and that really does make a big difference. We looked at reverse mortgages, and a lot of people think, well, I don't want to ever do that. That's about when they first came out, it was kind of sketchy. And over the years, they've improved. And now this past year, the FINRA, the organization that oversees the fiduciaries, have started putting out information to say, hey, look, if you're a fiduciary advisor, you need to at least consider reverse mortgages, because some advisors have been getting sued because they did not present a reverse mortgage as a potential option. Doesn't mean the client has to do it, but if you never talk about it and it could have solved their problem, that's the reason the fiduciary is important, is that they're obligated to show you a wide variety of options when it comes to how to solve your problem. So anyway, we appreciate Adam coming up and taking the next segment here on retirement investments. I think you shared the wrong, might have shared the your desktop.
Can you see it now?
No, you need to stop
screen.
probably you gotta make sure that your PowerPoint is available for your I think you're sharing the main desktop.
See if I can get back over here.
You'll want to stop sharing and reshare. And then just because you're a fiduciary doesn't mean you're any good at running technology. There you go.
Did that get it?
Yeah, you just have to hit the there you present mode. Okay, all right. Take it
All
away. Tell
right.
us who you are, Adam, how long you been in the business with us, or that sort of thing.
Thank you for that, Jake. You're exactly right. I'm not very tech savvy. Grew up on a cattle farm in Middle Tennessee. Started with Roy in 2008 with a finance degree, fresh out of college, and have had the ability to get to sit down with businesses and families ever since then, and explain about financial topics, and that's been a huge blessing. So, to talk a little bit off of what Jason shared, the difference in the different rates of return. One of the things that we always done growing up on a cattle farm was all of us had our own cow. So I had my own cow, and each year I would sell her calf, and I would get money from that. And we didn't mess with the stock market, so my money went into a savings account. And so, the growth on that was pretty much non-existent. So I've done the same thing with my kids. And so my son ended up raising his own bottle calf this past year because the mom didn't work out for that calf. And so with that, he sold it and brought him his check. And since he done all the work and everything, I said, hey, you can do whatever you want to with this money. It's all yours. I said, but just so you know, you do have an investment account. And if you put it in that investment account, it'll grow. So he's a spender, not a saver. And so he walked out of the room with his check, and I didn't expect to see that one again. But before the end of the day, he brought his check back in. He said, Dad, you know what? I think I want to put this in my investment account so it'll grow. And I was so proud of him, and put that in his investment account. And 3 days later, he came back to me and asked me if it had grown enough to buy an F-150. So I don't know that he understood that completely on the time horizon there. But he was pretty disappointed to know it hadn't grown very much yet in that 3-day period. So I am talking about retirement planning. So we're going to go over retirement planning. We're going to go over the accounts and vehicles that you can use for retirement planning. And then we're going to go over some strategies that work and strategies that don't work as far as making sure that we meet our goals. So I usually have two types of clients that I work with, that I get to work with when it comes to retirement planning. The first type of client is the one that comes to me at retirement. They're already ready for retirement, and they're wanting to do some planning. It's usually like 6 months to a year before they retire is when we get together. So usually the way that conversation goes is they show me the amount of money that they have saved up, and then I show them what retirement can look like. So the other style of client that comes to me and wants to do retirement planning is the one that comes much sooner, the one that allows me to be involved in the planning process. So that individual, we get together and they tell me what they want their retirement to look like. And then I can do all the calculations and the math behind it to show them, here's what you need to be setting aside monthly, yearly, to make sure that you get to hit that goal and that retirement that you're hoping for. So after that, the next thing that we need to do is we need to choose the right retirement accounts. And there's really two categories here as well. There's the self-employed individual and there is the employee. So the employee, hopefully you're being offered a 401k and you need to look into it to see if there's a match and what that match is, because that is definitely going to be the first stop when it comes to retirement planning of where we want to be dumping money into. We want to make sure we get that match and don't leave any money on the table. So the next option is going to be for the self-employed group. And the self-employed group is going to lean a little bit more towards SEP IRAs, simple IRAs. They are an easy way for a self-employed individual to avoid the IRS, hide some money from the IRS, and prepare for retirement. So another thing to think about are the other tax advantaged accounts. So a health savings account is another one of those. A health savings account is a good and easy way to deduct your health expenses off of your taxes, and the account itself can grow tax-free. So that's a big help. Especially like my family, we have 6 of us, 4 kids. By the end of the year, medical expenses and taking everybody to the doctor can amount to something. Okay, so when we look at our accounts, we want to make sure we've got the right account, and then we want to maximize our contributions. So what does that mean? So for the group that has the 401k option, the wording usually sounds something like this. They'll say, all right, your 401k, we are going to match 100% up to 5% of your income. So it's important that you know what that means. And in layman's terms, about 5% of each of your checks you need to be putting towards that 401k at a minimum, to make sure that you don't leave any free money on the table. And then, coming from our meeting and deciding what your retirement goals are, how soon you want to retire, we're going to be able to decide, well, is that enough, or do we need to be putting a little bit more? And the amount that you put in over the match, we'll look at your options on that. It could be that the 401k is the best place for that, or it could be that we want to look to do something different. So the other group, the self-employed group, choosing the correct account is really important here, the SEP or the simple. And really the difference is there, if you do not have any W-2 employees, then the SEP IRA is going to be a really easy way to dump 25% up to $50-something thousand into a retirement account and hide it from the IRS. So it grows deferred. For those that have W-2 employees, the simple might be the better way to go, but we can sit down and go through exactly what that looks like and which one is going to be the best for you. So after we pick the correct account, then we want to talk about risk tolerance and rebalancing. So we want to focus on a higher growth investment. And the time period that we want to focus on that is when we're building wealth. So there's a big difference in your wealth building phase and your withdrawal phase or in retirement phase. But when we're in wealth building phase, we want to focus on investments that have a high growth potential, such as stocks, maybe real estate, starting a business, things like that. But we want to start looking at your time horizon, because the market itself has a cycle of about 6 to 7 years. Meaning on average, about every 6 to 7 years, we go through a little bit of a market correction. So that downturn, if you're in contribution mode or wealth building mode, is an opportunity for you, because let's say you're investing in a 401k, you have money going in each month regardless of what the market is doing. So if the market is down, you're actually buying everything on sale. It benefits you in the long run. If you're getting closer to retirement, on the other hand, especially if you're within a market cycle of retirement, within 6 to 7 years of retirement, we want to make sure that we start backing off of that risk so that you don't experience a downturn right before or in the first of your retirement, which would cause you to significantly change the way that you retire or when you retire. Okay. And we want to adjust the investments accordingly. So according to your risk tolerance, every person is their own individual person. And so if you're a person that is okay with a little bit higher risk, then we're probably going to be a more large portion of your portfolio is going to be on the stock side. While if you're a more conservative person, we're going to lean more towards bonds or maybe dividend paying stocks. So one of the first conversations that I usually have with new clients has something to do with timing the market. So they'll ask me kind of what they can expect on getting in and out of the market, good, bad markets, things like that. And so this is one of the first things that I want to show them, just to kind of show how trying to time the market can be very, very dangerous. So what this slide shows, it shows the value of a hypothetical $10,000 investment into the S&P 500, and it was invested in 2013, and it ran until 2023, so a 10-year period. So $10,000 invested into the S&P 500 in 2013. At the end of 2023, as long as it was invested for the entire period, would be worth $27,248. If you had someone that was trying to time the market and missed just 10 of the best days over a 10-year period, then we lose 45% of that, and we go all the way down to $14,922. If we miss just 20 of the best days in that 10-year period, we go all the way down to $10,838. And if we miss 30 or more of the best days in a 10-year period, not only do we not make very much money, but we lose part of our principal that we put in. So I show people this to kind of stress that not only is it statistically nearly impossible to time the market correct, but it's reckless. If we're talking about retirement money that you're depending on, trying to time the market is a very bad idea. So if that is that bad of an idea, then what direction do we want to go? So the story that I heard that best explained this was a story about storm shelters. So I live in Middle Tennessee. In Middle Tennessee, we have tornadoes. And recently, in the last recent years, we've had a lot of people moving here from California that haven't had very much experience with tornadoes, and their reactions can sometimes be pretty funny. But storm shelters or tornado shelters are very popular in our area. And if you're going to go out and purchase one of these storm shelters, you typically go and find a very reputable company. And you want to look at the shelters they have available, and you want to choose one that's rated for an F5 or better. That way you don't have to worry about the strength of the shelter. And then you want to go find a really good install crew to make sure that it gets installed properly. And you do all of these things because the confidence in your shelter needs to be very high. If the storm comes, the only thing that you want to worry about doing is getting your family in the shelter. The worst thing that you could do is in the middle of that storm lose confidence and then open the door to your shelter and look around, make sure the bolts are holding. That's not how the shelter is designed. And your portfolio works the same way. So you need to have a relationship with your advisor to where you trust your advisor. You need to have a portfolio that you have gone over to where you trust that portfolio so that once out of 6 to 7 years, the market's going to drop and you're going to go through one of these storms. And you need to be able to weather that storm without getting scared and selling out of your portfolio. Because if you do get scared and sell out of your portfolio, then you will realize those losses. On the other hand, just like this graph shows, if you weather that storm and continue on, it can be a very good story as far as retirement goes. So very, very important distinction to make when you start meeting with your advisor. Just know that he or she is not going to be trying to time the market. It's going to be something where we get into a portfolio that we have enough confidence in that we're willing to ride out that storm. Okay, next we're going to talk about education savings, saving money for our kids. It's a really popular topic when I meet with clients, and there's really two categories here as well. There's the category where the family says, hey, we already know what school they're going to go to. We're excited about that. We are definitely going to use this money for college. What do you recommend? So in that scenario, a 529 plan is really hard to beat. A 529 plan, you can dump a ton of money into it, and it is going to grow tax-free, and you're going to withdraw it tax-free. So as far as saving money for college, when you know you're going to use it for college, it's really hard to beat the 529 plan. I have another group that want to save money for kids, and this group is different. They want to save it for the kids, but they're not really sure those kids are going to go to college and use it in that way. And this group is growing bigger and bigger lately, with my client base at least. And so if you're wanting to save money for the kids, you're wanting to get some tax benefits, but you're not sure what you're going to use it for, the custodial accounts is probably going to be your best route. So a UGMA or a UTMA, that's a uniform gift to minor account or a uniform transfer to minor account. So the beauty of this is you can use it for basically anything as long as it benefits the child. You can buy them brownies, buy their first car, pay for their wedding, or you can use it for school. What are the drawbacks? The drawback is where the 529 plan offers 100% tax-free growth and tax-free withdrawals as long as you use it for higher education. The UTMA is going to not be taxed on the first $2,000 of growth in the account. So if you put $5,000 in, it grows to $7,000. You don't owe any taxes, but any growth above that, you're going to have to start paying taxes on. But despite that, still one of the most popular, at least with my client base. Okay, so the third one is going to be scholarships and financial aid. We definitely want to use this for our kids. So we want to reduce the education cost by exploring scholarship opportunities and understanding how financial aid works. Filing the FAFSA early is a key to securing this aid. Obviously, a very important part. Okay, so let's just recap what we've gone over. Planning early matters. Planning early changes the conversation to here's what your retirement is going to look like, and it gives you that opportunity to decide what your retirement is going to look like and make those decisions early. You want to choose the correct accounts. That can be a huge difference, especially if you're being offered matches and things like that. We want to make sure that we don't leave any free money on the table, and we keep all the money away from the IRS that we can. We don't want to try to time the market. It's a really statistically bad way to make it through your retirement. On the flip side of that, you want to have confidence in your portfolio and your advisor. And we want to take care of the kids' accounts last. So we leave that. I left that till last on my little segment here because you want it similar to the way when you get on an airplane and the stewardess tells you about your oxygen mask. They always tell you to put your mask on first. I look at this a lot the same way. It's not going to do you very much good to buy your kids that fancy first car if you haven't taken care of your retirement. So you want to make sure you keep your priorities in order there and take care of things that you need to first. That's it for me, Jake.
Man, I love to listen to Adam. He's so even keel. He's kind of like the guiding light in our company when it comes to making good decisions. Next up, and I appreciate the information you just shared with that. In fact, you mentioned, early planning is best, but you know what? I did some research. every single day, there's 10,000 baby boomers that turn to age 65. So today, Roy, you know, he's not quite there yet, but 10,000 other people today had a birthday, became 65. And out of that 10,000 baby boomers today, about 4,600 of them do not have a financial advisor. And about 1,750 of those 10,000 have at least $250,000 in investable assets, and they don't even have a financial advisor. So every day there are floods of people coming into our market. That's one of the reasons why we're looking for new referral partners to come to work with us. But if you think about that, it's never too late. Those people need help. And if you know somebody that falls in that category, they need to get with a financial advisor and take those assets that they're coming out of retirement or 401k, that sort of thing, and put them to work for them. All right, so next up, we've got Dave Wilhite. Dave's going to talk about annuities, which is a crucial component to not only protecting your investments, but it's a way to put insurance on your investments, if you will. So, Dave, are you up here, brother? Can we see you?
Where, buddy?
Okay, and then if you'll share your screen you have a PowerPoint to share? You make me nervous, Dave.
As I should. For those on here that know my tech abilities, it's searching.
Okay. Going to be looking for your open PowerPoint presentation.
All right. Pull it back up here. Can you see that?
Okay, there you go. You want to, well, I don't know that you're not sharing that particular, okay. For some reason I'm on the screen down there.
It's sharing. You can't see that?
Yeah, but it's like a screen within a screen. It's not full screen. Stop sharing and reshare.
Man.
Sorry, guys.
Hey, Jake, I'll put
You
it
want to
up.
do it?
I'll put it up for you, Dave.
All right. Well, so
Dave,
you're gonna have a chaperone.
There you go.
All right.
Uh,
Okay. Good deal. So take it away. Tell us a little
We're
bit.
up.
Tell us a little bit about who you are. How long you been?
Jake, that Roy didn't have any gray hair when I first started. I've been here about 25 years. So I've been here for a minute. And, you know, Adam, good stuff on there. When you were talking about the cow being the retirement plan or the savings plan, I'll never forget. I had an appointment up in Portland. I'm sitting there and the guy goes, "Look out that window right there." I'm like, "Okay." He's like, "That's my emergency fund. Whenever I need money, I sell a cow." Okay. He goes, "See those cows over there?" I'm like, "Yep." He goes, "That's my retirement plan." I'm like, "Okay." So I can relate a little bit with Adam going through that. So I'm going to go real quick here. Everybody wake up, shake it up. We're on the home stretch here. So I'm just going to talk a little bit about annuities and the how they can interact with your financial plan. What is an annuity overall? An annuity is you're basically just transferring your risk. You're transferring the risk to an insurance company. They offer tax deferred growth.
Did we lose him, Jake? Hello.
Did we lose Dave? Roy, you're going to have to pinch hit, I reckon.
Yeah, I don't know what happened.
Well, he probably dropped off, maybe a signal issue. Why don't you go ahead and take over if he pops back on?
All right, we'll roll. I know a little bit about annuities. Let me hang on, guys. I'll get so you can see me. Let me get all this going here.
Dan says he dropped his phone, so I don't know what that means. Maybe that's what he's working off his phone.
All right, guys, we're gonna wind this up and let me get the name on there, face on there, and we'll finish it up and knock this out. So anyway, so we're gonna finish up with annuities, and then we're gonna jump into um, really what I would do in each category of your life. And so, what is an annuity? An annuity is a financial product. Insurance companies offer it that provides lifetime income payments. They generally, I tell people, annuities are for tax deferred growth and for a lifetime income guarantee. That is what we're looking for when we do something like that. Anytime you buy an annuity, you're buying the what if. What if I live to 101 like my mother, and my mother's 101, and we want to have a lifetime income guarantee. The second thing is it offers tax deferred growth, so you can put money aside today, maybe money that you'll never use. I have money in annuities with the idea I'll never use it. All right. So that money grows, and it grows tax deferred. So there's a bunch of types of annuities. You got fixed annuities. I would compare a fixed annuity to a bank account CD. What it does is it provides guaranteed payments with a fixed interest rate. You can put that in. It's about like a CD with the insurance company backing it up. A MIGA is very similar to a CD in that it is a guarantee. I saw, guaranteed MIGAs for 10 years that were 6%. So you could put in a lump sum of money guaranteed by the insurance company, and it pays you 6%. It wasn't too long ago, people they could put $1 million aside, and they got 60,000 a year guaranteed for 10 years, and then it renews. That would be an example of a MIGA. A variable annuity allows a various sub accounts. So what that means is you can take your money and put it into different. An annuity, when it says sub accounts, that would be like stocks, bonds, cash, things like that. It allows investments in there. And a variable annuity has the up and the down, but the main key that a variable annuity does is it gives you tax deferred growth, and it gives you lifetime income guarantee. So people that buy variable annuities are looking at a way to grow their money. It's over and above their retirement plans, so they get tax deferral. We got fixed indexed annuities. Think of a fixed indexed annuity. If you're at or near retirement, think of never goes down, only goes up. The way a fixed indexed annuity works is I may have a cap rate on it. So let's say it's tied to the stock market and you have a 10-point cap. That means that the first 10% of the growth in the stock market year to year, we get 10%. Anything above 10% in the stock market, you only get 10. But if the market goes down, you get 0. So you have no losses. And what this does is allow people to have downside protection and avoid what we call sequencing of return risk. What that means is that when the market is going down and you're retiring, unlike dollar cost averaging we talked about earlier, dollar cost averaging says when the market goes down, you're buying at a discount. When the market goes down, when you're retiring, you're selling at a discount. So if the market dropped 50%, that means you got to sell twice as many shares. So people use fixed indexed annuities to avoid that bad sequence of return. So if you retire and immediately we have a market downturn, we have what's called a registered linked index linked annuity. What that is, so what an index linked annuity is, or what is called a RILA, they will offer some upside but downside protection. So for instance, some of them may say, well, for 6 years you put your money in, it grows tax deferred, it's tied to the S&P 500, and we have a 20% buffer. That means that if the market's down 20%, we're going to make it up at the end of 6 years. So you don't, if it's between 0 and 20%, you're not going to lose any money. It's never done that. Okay. More than 20%. So pretty much if you have a 20% downside over the last 50 years, you would have never lost money. And then they may give you 125% of the upside or something like that. So maybe if you put in 100, it could grow to 225. If we had a rocket stock market and the market itself went 100 grew to 300, well, you only get 225. So that's another product. So these are different ones. The pros of annuities: guaranteed lifetime income, tax deferred growth, principal protection of some sort. You got customizable payouts, meaning you can take them now or later, and you have optional riders, okay, with the idea of enhanced death benefit, long-term care benefits, things like that. So we use annuities as a retirement planning tool for someone. So if you're at or near retirement, or if you've got extra cash you don't expect to use, they do have some good ideas there. So cons: limited liquidity. Never put your money in an annuity if you think you're going to need it, unless you're buying it with the intention of using it as a lifetime income guarantee. Annuities cost more money. The reason they cost more money is because they're an insurance product. How about that? You're buying insurance. You're paying for some downside protection. I view it similar to if you go to the bank, you buy FDIC insurance, and so therefore you get a lower return because you have insurance. If you buy an annuity, you have different fees for the insurance portion of it. What does the insurance portion give you? It gives you tax-deferred growth, lifetime income guarantees, potentially long-term care benefits. Complexity, you got to understand them. Certain annuities they have surrender charges. They have things that if you get into it, I always tell people, do not buy this, okay, if you don't understand it. All right. And the way you get to understand it, you should have someone sit with you and really go through there. The other negative with an annuity is if you get a lifetime income guarantee, typically that doesn't go up. So we have to deal with inflation risk and purchasing power. So typically we will combine a lifetime income guarantee and we'll do a growth side with something that can grow for the future, which allows you to offset inflation risk. And if you pull it out, it's taxed as ordinary income. So there's no capital gains rates on that. So that's pros and cons of annuities. Who are they best for? Retirees needing reliable income, long-term savers seeking tax advantages, okay? Risk-averse investors wanting some level of principal protection. So think of a fixed or a fixed indexed annuity. Take that and look at it with the mindset that what's going to happen is that you're going to have downside protection, all right, and you've got tax deferred growth, and you have a lifetime income guarantee. That's what people use annuities for. So I was making sure I was on my time there. All right. So we're in a battle to win. What is the battle? Okay. When it comes to your money, you got to outperform taxes and you got to outperform inflation. That's what we're in it. All right. So when we go out and we start looking at things, annuities provide opportunities to get some tax deferral. And also, if you're in a variable or a RILA, you have more upside protection to offset inflation. All right. So what we tell people is we're going to have different buckets. All right. What are the buckets of money? We've got some in cash. We got some in a non-qualified mutual fund. That would be like opportunity money is what I call that. We have qualified funds. That would be mutual funds or managed money. And that what is qualified? Think of this. If you have a growth fund can be qualified or non-qualified. What makes it qualified or not qualified? It's a tax stamp, okay? So that tax stamp says, stamp it qualified, it grows tax deferred. Stamp it qualified, it could be tax free. That would be a Roth. Stamp it qualified, it could be tax deductible. That would be a traditional. Stamp it qualified, it could be a deductible 401k or a Roth 401k or a 403b if you work at maybe a hospital or a school system, something like that. So we need to know the difference in qualified and non-qualified. Now, why does it matter? Well, non-qualified money is assessable. All right. What that means is that you are not going to pay penalties for early withdrawal as far as tax penalties. A non-qualified money would include just a regular bank account or or a mutual fund. It can be any of that kind of stuff with the idea there's no 59.5 penalties. Life insurance. Joe talked about life insurance, where you can get what's called an index life insurance policy, allows you to pull money out. It's not a qualified account. You can get it out prior to 59.5. Then we have qualified mutual funds. Then we have annuities, and we put those in the bucket so we can have lifetime income guarantees. So we're building things up to become bulletproof. The whole idea of our program today was become bulletproof. That is the idea. Get an automated system of financial independence. Automate your financial independence. First thing you should do is ask questions. You know, there's no dumb questions. All right. I can tell you that when it comes to your money, I want you to ask questions. If I'm meeting with you, I want you to understand it. All right. Because if you're educated, you know, I've been doing radio for many, many years, did 9 years, 3 hours a day, 5 days a week with Dave Ramsey, answering questions. And then, you know, I've been on the air for the last 6 years. And why do I do that? I have people, they tell me all the time, they're like, what, you know, are you getting a lot of business off of that? And I said, yeah, we have people that call off the radio and stuff like that. But mostly what I have is I have my clients listen, and they listen and they're educated and they become better clients because I can carry on a conversation and they are more up to speed. So part of this today, I want to compliment you just being here. You want to look for any potential red flags out there. If you've got red flags, what are red flags? You got a bunch of credit card debt, or you got a bunch of, you got big car payments. You got, you know, you have money just floating along. You don't have a budget, things like that. You need to have money in non-correlated assets. What that means is you want to have things that perform differently. Let me give you an example. If you were selling, if you had a stand on the beach and you were going to get non-correlated assets to sell, you would sell an umbrella and you would sell sunglasses. So what would happen is if it's sunny, you're great. You're selling your sunglasses. If it's raining, you're selling your umbrellas. All right. Totally opposite types of things. That's why we want to have a certain amount of our money in stocks, bonds, cash, and annuities. That way they perform differently depending on what the market does. We have fixed money and fixed, and we have equity, and we have cash. What is cash? Cash is like a money market account. What do you do with cash? Well, cash has a couple things to go with it. All right. One is it's an emergency fund, but the other is it's a buy-in. All right. What do I mean by a buy-in? So if we have a certain amount of our money set aside, okay, in cash, if we're retired, that gives us money we can use should the market go the wrong direction and we don't want to pull from, say, a stock market account. It's also an opportunity fund. So we may have a little cash on the sideline right now. I run into people all the time. They say, yeah, man, I've got a little extra cash. And I'm like, all right, well, let's take a look at ways for us to do a buy-in. So if we have a pullback in the market, we may buy in to that. So that's how we do that. And I can give you example after example, and that's what I'm going to do now is kind of close out with some examples. And Jake, you know what we ought to do? Make sure, you know, we got a chat out there. Let's see if we got any questions that might want to be brought up, and then I'm going to jump into the
There's one question here, Roy. It says, I'm in a process of a HELOC with a bank. What should I verify before signing the agreement? It's probably
All right. Well, I mean, a HELOC, the whole HELOC with a bank, you know, most of the time a HELOC is going to be up to 80% of the total of your property. So if you've got, based on the fact if you financially can qualify for it. And, you know, the biggest thing that I say with HELOCs is fees. You know, I would look at my fees before I do anything. A lot of these are doing it. They do it with just very few fee, a little bit of fee, maybe $200 a year kind of type of fee. So I would look at that. HELOCs are generally a variable rate. All right. Interest only. All right. So that's fine. So with that being said, that would be my thinking on a HELOC. I always recommend people get HELOCs. It's special when they're working, if they've got equity tied up, you know, in their house. So if you've got a house that's worth 500, as Joe was talking earlier, and you owe 200, they're probably going to loan you up to 400. So now you have 200,000 owed and 200,000 of potential firepower. Now, what could you do with 200 grand? Well, who knows? All right. What if an opportunity comes along and you know, and you were able to make 50 grand and you don't have the 50 grand to put in? And so we always want to have the ability to access cash. That's why I tell people to do that. It's a big emergency fund. So any other questions, guys? If you want to put them in the chat box, we'll do that. I'm going to get rolling and then
Hey, Roy,
close out. Yes.
there's one more question about your HELOC. When is it over? if you borrowed money against your HELOC, you want to make sure you know what the terms are about paying it back. Does it convert to a fixed account at some point, or do you have to refinance it? It could be a 5-year or a 10-year.
Right. Yeah, most of your HELOCs renew, but they automatically renew. But you know, there may be a period of time where they want to run your credit again. So you just need to look at it from that standpoint.
And
So
if there's an issue with the banking with the economy, there in the past, bank might decide to close your HELOC. If you're not using it, you've got access to it, and they said, no, we're not going to do it anymore. We decided that the market's too risky. You may see that happen as well. You need to look to
yeah.
see if that's in the fine print.
Yeah, and I guys, I've been referring HELOCs forever, and the reason I have a mortgage license, but we don't actively, do that. But I have referred it. I can tell you that especially when you look at, if you have a single income earner, wow, yeah, and that would be a big reason. Okay, you always want to be here's the thing. I always have access to cash. That's the key to it. It allows you. I'll give you another example. Let's say you have a HELOC and something happens. It would allow you to borrow money rather than pull out money out of your retirement account, which would get taxed and penalized and stuff like that. So anyway, it's a good question. All right, let's do this. We're going to get finished here. I'm going to pull together everything we talked about now. And in doing this, I'm going to give you some examples of what I think would be a way of looking at things. So, my mindset is that in the financial advisory business, what we do is we go from birth to after death. All right. And when I say birth to after death, so what happens is that, if you have a baby, or you have a grandson or grandchild, or a teenager, whatever, first thing that I would want to do is make sure they understand the difference between a bank and an investment. All right. And I've done this. I did a family financial workshop. We did it like this, and we even do that where we would, if you rounded up your family, it started with me. I have 3 sisters. I have a brother. My mother's 101. All of my sisters are alive, and my brother's alive, and we've got grandkids. And great. There's 5 generations. All right. We celebrated my mother's birthday, 100-year birthday. She was born in 2023, and we had a new baby that was born she was in 1923, and we had a new baby in 2023. So basically what happens is we had them everywhere. So one day I said, I want my whole family to understand things. And I did a family financial workshop, and I invited everybody over, all of them, and any of them that I gifted to all of the kids a $250 mutual fund. I had 27 of them I gifted. And so $250. And so now, rather than running out of the bank and opening up the savings account, which the bank has its reasons, now if they want to add money at Christmas, so they can throw it in their account like that. So that was the beginning. So you want to create a family tradition. So what would we do? We get started. These are the things you should focus in on. Number 1, 10 times your income with term insurance. I had a client that actually the son of an existing client, he's 32 years old, wife's 28. They're making about $120,000 a year. We were able to get term insurance for about $100 a month for over $1 million of coverage. Disability income, you can purchase that individually, which will replace up to about 60% of your income, or in many cases, you have options through your job if you to do that. Liability insurance would be home and auto insurance. Once you have an emergency fund, what do? We raise the deductibles in order to cover costs. We might buy what's called an umbrella policy to do that. We have a money market account that's for our emergency funds. We have growth funds. That would be something that would be accessible, that you can grow your money. We have indexed life insurance policies. And then we do your company sponsor plan. Included in that might be a Roth IRA if you don't have that. So that would be what I would do. So if you have $1,000 a month, we would take it and we would put it in here in this. And before you know it, it's like boom, boom, boom. keep it in, keep the checking account or the payroll coming in, and we'll take your $1,000 and we'll divide it up and put it into something where one day you've automated your financial independence. So you don't have to think about it anymore. You say, I got that off the table. That would be there. Now, if you're middle age, you're accumulating, that's when you're probably going to do all the things we were talking about, but we're going to add what's called variable annuities. And that's where you can get additional monies set aside in order to be able to grow it tax deferred. That was the RILA, or the true variable annuity. And so the idea behind this is you're fully funding your retirement accounts. I see this all the time, people that can fully fund their retirement accounts, but they're not doing it. So if you're 50 and up, you put about 30 grand into your 401k, 403b. That can be deducted, all right? And that would be enough deduction to fund your Roth IRA for free. So you say, well, let's just buy one, get one free. Let's fully fund the company plan, take the tax savings, throw it into a Roth IRA. That would be the accumulation stage. So if I meet with someone, we're going to look at everything they're doing. By now, they're probably in managed accounts, because what's happened is they've changed jobs. They may have a 401k from a previous job or something like that. Don't let your 401ks just sit. All right, because if you do, the rule of 72 applies. All right, and if you're getting 3 or 4% versus 10 or 12%, it's literally the amount of difference is unbelievable. To give you one little number, when you retire over a 20-year period, when you start withdrawing money, 0.5% increase in return is 7 years of income. It's insane what happens. So we want to make sure and get our money working for us. Next thing, you're at retirement stage. We're going to have some stock and bond funds. That's going to be about 2/3 of our money. We're going to have something in a lifetime income guarantee to supplement Social Security, of a money market account. That's your emergency money. We might look at a healthcare annuity. What that is, there's annuities out there that you put in 100 grand and it'll pay 300 should you go in the nursing home. If you don't use it, it's still growing, and it's an inheritance, okay, to your kids. Final expense is the final expense. Here's what happens. Three things happen when people die. They don't, you go to the funeral home, and the spouse, you lose a spouse. So let me tell you what happens at that point. Well, first off, you got the cost of the funeral, and you got things like that. The second thing is you lose one Social Security, and then the next year, if your income is up and you're living and you got the same income as it relates to your withdrawals, you become a single taxpayer rather than a joint taxpayer. So your taxes go up. So all these kind of things come to play when people pass away. Final expense, and then the last thing I want to cover is one more essential element of a well-rounded financial plan, is called a will and a trust. And we talked about it. Wills distribute assets, okay, and a will and appoints guardians for minors. So if you have children, you're going to want to have something. If you have a living trust, it avoids probate. It will provide privacy and ensure seamless management of trust assets. So why do we have a trust? I'm going to give you a couple examples. One is second marriages that have children on both sides. So what happens is you tell that money to go, your money goes into the trust details it, okay? And then that way there's less chance for any type of arguments. Financial power of attorney manages financial affairs during incapacity. Let me give you another example. If you have children that are now 18 and they were to go off to college and be in some kind of accident, if you don't have a power of attorney, financial power of attorney, or a healthcare power of attorney, you can't make decisions for those kids. And so we talked earlier about that we have products that actually include these things. And then the last one is a healthcare directive that basically says, look, if something happens to where I'm incapacitated on life support, I'm going to make the decision rather than make my kids do it. And so a will and a trust is very important it's kind of a foundational type thing. The living portion is a financial power of attorney, healthcare power of attorney, and the advanced healthcare directive. And then the trust portion is avoids probate, and it gives directions on how to distribute. So, guys, I hope this has been beneficial. I know we've had people on here. We're finishing up about it's 12:18, and we see that you've been in here. So we hope this session was valuable. If you feel we've provided information could help others in similar situation, we would greatly appreciate you doing two things. Go to roymountainlakejr.com and give us a 5-star review. All right. This helps others discover our seminars, helps us understand what we're doing right and where we can continue to improve. If you know friends or family members who might benefit, we'd be grateful if you could share their names. Whoever sent you this, reach back out to them. They're the person, they're your contact to get to us. Our goal is to make financial planning as clear and accessible as possible. And your referrals allow us to reach more people, continue to offer these sessions. The last thing is schedule a phone call, all right, with the person and get your automatic plan in place. I say get your automatic plan in place because it really is that. If you get advice and education, then what we do, we go defense, offense, marketplace. We pick and choose the places for you to put your money, be it insurance, investments. We're not tied to any one company or anything like that. And then once you're with us, we do regular scheduled reviews so we can update and keep you on the road to financial independence. So Jake, anything you want to close with? I think we've got it all done. So
I want to make one point. When I ask our happy clients to maybe think about people they care about, they think should have a conversation like we had. When you're thinking about referring someone that you care about to us, we want to let you know that we guarantee that we will not embarrass you. You will never have a situation where you're referring to somebody on our team that you feel like, okay, they were putting high pressure on them, or that guy was a jerk. You could just go back and remember the person that you're doing business with now. If you're a client, you remember how you were treated by Adam Smith or Joe, or some of the other guys here, Jason. That's how we're going to treat the people you refer to. So we want to guarantee that we'll have a great relationship. The worst thing that's ever going to happen if you refer people to us, we'll educate them. They will learn information that they can take and implement in their daily life, even if they don't become a client, which is okay. We're fiduciaries for that main reason. On the other hand, so the worst thing will happen, we'll stay friends, and you will get a report back from them when you talk to them, like, that person, that man or that woman was really cool. I appreciate how they treated me. I didn't do business with them, but you know what they might do? They may actually refer business down the road from people they know. It's just maybe the timing's not right for them right now.
Well, and during this phone call, a lot of times we can, I see most times that I meet with people, I can show them right off the bat in a short phone call how they can save money or do something better. It's very seldom do I meet with someone and I say, hey, you got it all together. All right. Now, once we get through, you're going to have it all together. We're going to have all the things in place like that. So anyway, guys, thanks for tuning in. Expect a replay link to be emailed to you that you can go back through and watch it again. And
forward it to a friend or relative as well.
Yeah, forward it out. And we will be doing more of these. We like to kick them off at the beginning of the year. Y'all have a great afternoon. Thank you.